Good afternoon, everybody. It's 11 a.m. on September 18th, and we're joined by Jim Colburn of Commodity Research Group. We've already spoken to Andy LeBeau and Ed Meir of Research Group, and Jim is the third partner of that firm, which really has a lot of great information. They break down the macro markets, energy markets, metal markets, and they all have kind of a different role, and they fit really well together. And Jim really helps implement a lot of their research into trading opportunities. So it's going to be great to speak with Jim, get a sense of what they're thinking, what Jim is thinking, and different ways of expressing those views. So Jim, welcome. How are you?
Hi, Michael. How are you?
Great, great. It's been an active market. We've had a lot of activity over the past 2 weeks between storms affecting the market, tariffs affecting the market, Middle East, tension in the Middle East. And so, yeah, it's been a lot of activity. Markets have been moving around a lot. But I thought it would be interesting if we started out, if you could tell us a little bit about the way you analyze the markets.
Sure. My background, I worked for the exchange, the NYMEX, in 1986, and my job was to roll out the brand new oil options contract. So I went to all the oil companies, did presentations, and I learned, their business as they were learning how to use options in their hedging and trading um, situations. And also what we uncovered was that the oil markets, energy markets, are infested with optionality naturally. So, for example, a storage facility, a lot of oil companies way back when didn't understand that that's an option on the spread. So, it's like owning a put on the front to back spreads. So if you look at it that way, you treat the asset a little differently than you might, and how it's changing value every day. So that's kind of how I got into the oil business, oil energy business, and for about 20, almost 23 years, I sat next to Andy LeBeau, who is, in my opinion, the top energy analyst in the world. So we would just throw ideas back and forth, and from uh, I'd mainly like to look at charts, and from Andy's fundamental input, we'd come up with trading ideas for our clients. And so that's basically it. I was in a grad school class on agricultural commodities, and they spent 2 weeks on futures markets. That was 1979, and I was hooked. My first job was at the USDA, so I have a broad commodities background, but mostly I fell in love with options, and that's where I focus my time these days.
Interesting. And so, give me your take on what you see happening. We've had a very active past month. Energy has been active among other commodities. What are your thoughts right now?
Well, we look at this very important monthly report that the IEA puts out, their oil market report, and at the last line in their summary was things are tightening up. And Andy and I have been talking about that all year. The markets have been talking about that all year. And what we've seen is that the markets were the most open interest in options for a big part of the year were in these fourth quarter calls, December calls, and that goes for Brent and WTI. So, if we're looking at something like Brent, the number one option with the most open interest is the DEES 100 call with about 49,000. That's a decent number. DEES 80 calls is number two for Brent. In WTI, it's actually the DEES 50 put, but the top 10 in the top 10 open interest calls, seven of them are December. Now, we're getting close to December, so that makes a lot of sense, but it's been that way for a while. So this is, to me, the IEA's comment, things are tightening up. This has been the most anticipated tightening market that I've seen in a long time. So, it begs the question is if the market's getting tight and everybody's anticipated it, can it continue to go higher? When you listen to the fundamentals, it's hard to build a bearish case. I asked Andy in our last podcast, how's this thing come off? You mentioned a bunch of things. I mean, most recently is the Iranian sanctions coming up November 4th, I believe. President Trump has been very aggressive, and originally people might have had something like the sanctions taking maybe 500 to 800,000 off, then it's 1 million. Now it's like 1 million too. So, his commentary and his his tweets have been suggesting that he wants Iran to get down to zero. Now, we don't expect that to happen, but that's a very, the second part of that is, can and will OPEC make up for the difference? Will the U.S., other supply make up for the difference? And even in those situations, the U.S. has got some, their growth might be stymied a little bit from takeaway capacity. We were talking about that earlier in the year, and it seems to be coming into play. Maybe new pipelines come in, I think, second half of next year. So there's not going to be too much help there, although the mid-continent refineries are enjoying this lower WTI price for sure. There was also this talk of a gap of cap spending. There are aging oil wells, and we reached lows in 2016. So the cap spending is down. They're not going out and finding more oil wells. Venezuela, Nigeria, Libya. So there's all this stuff. World demand. I mean, we're looking at a GDP growth for the world of plus 3.8% this year, plus 3.6 for next year. So where is the bearish story? And quite frankly, that makes me nervous about being bullish. I mean, if you're in the commodity world for more than a week, you get to understand that.
Well, even just to kind of go with what you were just saying, I have to say most of the people that we speak to that take a more macro look at the energy market are bullish. And I mean, when I actually say most, I think every. And so it's interesting. And, the one thing that I was actually even just wrote a note down to look at is like, where was this, in 2015 when oil was down below $30? It's amazing how quickly the stories can change, because as you were just talking about, the supplies and demand are basically, in a lot of guys that look at more macro views, it's pointing to higher prices or supportive prices, whereas a few years ago everybody was as bearish as possible. Even had some people, Dennis Gartman saying, I'll die before it goes back above 40, and here we are, nearly double that.
Well, I have at least one Dennis Gartman type call back in the early 80s. I was trying to hone my public speaking skills, so I volunteered to speak at any and every organization, and I got in front of this Mortgage Banking Association meeting, and they asked me if I thought interest rates were going lower, but they asked me if we'd ever see interest rates back in the at the levels of the 60s. And I mean, these were double-digit interest rates at the time, and my comment was not in my lifetime. So I totally understand.
So you were actually right. You were looking for interest rates lower in the 80s.
Well,
here we are right now. It only took about 30 years.
Right. It was exactly.
It's all about time frame.
It's timing is everything for sure. But I understand, where he's coming from.
Yeah, and I was only just pointing out how, in a way, it's just amazing how the mantra changes so quickly, because even then it was like, we're never going to have the demand. There's unlimited supply, and the demand isn't going to pick up to support prices. And here a lot of people, like you said, and everybody's making a compelling argument for why prices should be supported. But like as you just said, tentatively, it's a lot of people have that sort of view, and so it's almost like what's going to be the shoe to drop to change that.
Well, I love the IEA. Their monthly reports are excellent, and even this, if you don't pay for it, you get the summary, and then a few weeks later you get the full report. But they're a great contrarian indicator. So I mentioned before, they said things are tightening up. Okay, but back in was it February of 2016 when we reached a low? I can't remember exactly when, but their report was, we're swimming in oil. There's oil everywhere, and within a few weeks we hit the bottom. So I mean, as a commodity person, if you don't get into commodities with that kind of angle in your thinking, it's tough to make sense of what's going on. But once you're in the commodity world, it doesn't take long for you to see a few of these things happen. And the old adage, the cure for a high price is a high price. So that's where the bearish case would come from here would be a decline. First of all, the economic numbers, the GDP numbers worldwide might be too high. Where we've got trade wars going on, we've got stock markets of emerging markets, down sharply. So, does that show up in less demand, lower demand than what's expected now? I think most of these groups are looking for 1.5 million growth this year, maybe about the same, a little less next year. Maybe that doesn't come to pass. Maybe we get Nigeria and Libya to have stable output. Maybe OPEC comes up with more barrels, and maybe the takeaway in the U.S. comes on faster. You just don't. You can't sort of point to what will cause it.
Yeah, absolutely. So, you really implement a lot of the strategies that your team comes up with. So how do you go about looking at, let's take a look at the energy market right now. Where are there opportunities, and, how do you look for it, whether through options?
Well, Andy's been calling for a trading range market for a while. And you can say, okay, trading range market indicates a short vol type strategy. You sell puts and calls. You could sell straddles. You could sell strangles, which would be, you pick out the range you think it's going to be, and you sell around it. And those kind of strategies would have worked over the last 6 months. I have a hard time. I come to this option world with a bias to be buying options. I know you probably get emails every other month saying I've got somebody who's got the system by selling options. They're going to make 200% on your money.
Exactly.
And yeah, and I know they always have a stat: 70%, 80%, 90% of options expire worthless, and it's really even if those numbers are true, it's expected value is what you should be thinking about. I mean, if you think about 2014 when the market went from 100 and collapsed. I mean, I know a lot of people, trading groups, gave back years of profits from selling options, and some of them went out of business. So that's the kind of thing, you're making money by selling options little by little. So what I try to do is if Andy's got a range, I'll wait for the market to get down to the lower end of the range or the upper end of the range and suggest the selling of the options as long as we still think we're in a trading range. Now it's kind of scary to be selling. You get a little rally going here. We haven't taken out any sort of resistance,
Well, we've seen tremendous short-term volatility. Like even today, I mean, we traded in Novi, we traded 68.29 to 70.17 is the range, and right now we're pretty close to the middle of that. I mean, we're talking a $2 range, and I think the entire range for the year is, let's call it $13 or something like that. And so each day we're getting these large intraday moves, but we're staying in that longer-term range.
It's a great comment, which makes selling the options difficult because it scares you when you see these moves. But when you look back, you're in the same place you were 3 or 4 months ago. So if you're buying options, it's confounding. So if you look at the implied volatility right now for crude oil, it's around 25%. And if you look at the long-term average is around 33%, and the low is around I want to say 13%, and that occurred in 2014 in June. So basically, my point is, yes, it's moving around, but we're not really seeing a bump, maybe a little move in vol, but implied vol, but not very much. And you need to break out of this range, I think, to get some really excitement going. Trading since September came around, the trading volume has picked up in options. It was dismal especially in August, but in the last quarter or June, July, August. And yesterday was below 100,000. So you see a lot of people just not trading this market, and it makes sense to me.
Yeah, so what are you, obviously you've been talking about the ranges, but so when you look at an option, like are you looking at the near expiration, like so for instance, maybe the weekly, monthly, are you looking at December? I know Andy looks a lot at curves and whether it be
Yes.
1 month, 6 month, 12 month sort of opportunities, what sort of duration?
Well, for me, I look at what Andy, Andy's talking about, say earlier in the year, he's talking about fourth quarter tightness. I'm looking for situations. I'm looking for the paper flow, the trade behind it, and we actually did see $100 calls trading. There's three different strikes of 100 that are in the top 20 open interest. So, but when I'm trying to call a price move, I mean, I'm just looking out a month. I mean, that's I can. It'll be if I put out a price call on a market, it's pretty quick whether I'm right or wrong. And I guess I'm just again, my original background is a small speculator, and you can't be wrong in these markets for very long, while you get your head handed to you. And that goes for any kind of trade I recommend to clients. Is here's what I think's going to happen, and if this happens, then I'm wrong. I always try to have an exit. So basically, to answer your question, I'm looking about a month out, maybe one expiration, two expirations, and then I follow the paper flow in the whole curve to see if there are any anomalies, weird things that are happening that we're not picking up. So I have to say, there was earlier this year, we saw probably one person, but a huge volume of flat puts bought in the spread markets, and that in the market, the front to back spreads were actually strengthening, and I looked at Andy, what's going on here? And sure enough, the market turned around, and then actually we went contango for a little while. So this guy had seen something, and I think it was we're going into the spring turnarounds, and so demand for oil dampened a little bit, and then got the more crude oil into Cushing, and it caused the market to go the other way. So it was really a brilliant strategy, and it worked, but it kind of gave us an indication that we weren't picking up, what's this guy thinking? And it doesn't always work that way. Sometimes people are buying options, selling options. You go, okay, that's a producer hedging. They might even have a bullish view and they're buying puts, so that's a possibility too.
So when you put on an option position, though, give me an example of a few recent examples in terms of, do you just put on, are you buying a put or buying a call, or are you doing like a complex strategy? If you could take me through an example or two.
Yeah. So earlier this year, we came into 2018, and if you recall, we had some problems. First of all, we had the hurricane of October 17, and took out a bunch of refiners, and then we had some problems in the North Sea that drove the market up as well. And I just felt like if this stuff, especially the North Sea stuff, we start getting back to normal. And the funds were just outstandingly long the market. And I said, there's just looks like an area there's too much length in the market. And if it liquidates, we might get a nice move backwards. So knowing that I was kind of picking a top, I wanted to buy puts because if I was wrong, my risk was limited to the premium that I laid out. And if you're wrong picking a top, you may be wrong by a lot, right? If it was a double top, at least I'd have an exit point of where my trade was, wrong. But this time now, I'm just saying, okay, this thing should be turning around any day now. And so the other thing about buying puts in oil, if you get a price move down, you tend to get an increase in volatility, right? So it's the tendency of the market. If you have a country like Mexico that goes into hedge, they buy a lot of downside puts. The market makers are on the other side, they sell. And what they'd like to do is like a reinsurance type thing. They'd like to get some of that off their book. And there's no other market makers to do that oftentimes. So they're stuck with this short put position. And then if the market goes down towards those strikes, they've got a delta hedge. They're not gamma flat in the vernacular. So they really have to. So what happens? What that means is that you have a producer who's long puts and a market maker who's short puts. As the market drops, the producer just sits there. They don't need to do anything. They may take profits, but oftentimes they'll just sit there. But the market maker has to sell futures along the way to cover those puts because they weren't able to buy puts around it because that's not the way the paper was flowing. So that, I think, is one reason that the tendency in oil on a down move is to increase supply volatility. So my point is, you could buy early in the year, you could buy deep out of the money or relatively deep out of the money puts, and if you got a nice $10-15 move down, you wouldn't be confounded by people selling aggressively into those puts. You probably would get an increase in vol. So what happened was the stock market came off. You got lucky. Stock market came off. Every piece of oil information that came out after we put those puts on was bearish, and the market came down, and it was a good trade. So the idea of buying the puts was because the market was in an uptrend and we weren't sure if there was a high. Now, another trade that we suggested was on one of the declines that Andy, we recognized, but Andy didn't think the market was going to really continue downward. And that one was a market where we thought maybe the market would go sideways to higher. And that's more of a put selling opportunity. You can take a couple of dollars out of the money and sell some puts, and then if the market just starts grinding sideways and moves a little higher, you do okay. And oftentimes, if you buy calls out of the money to play that, the market grinds sideways, grinds higher, and your calls just don't fire like you'd like them to. So that's the kind of stuff that it's kind of looking at what kind of market we're in. So now we're still. One other thing, the trading range. I'm looking at October futures, and the trading range, going back 5 or 6 months, is getting clearly traced out. And so you'd say, okay, well, if I sell like a 64, 63 put, sell a 72. Maybe 72 and a half call, I've got the range right there. And the problem with that is, in my experience, the more that these trading ranges are clear on the chart, the closer they're getting to a breakout point. So, you really want to be compensated well for your selling of the puts and calls to do that, and be careful because we're probably getting closer to a breakout point.
Yeah. Take me through what you're seeing right now in the spread differential between Brent and WTI crude.
Yeah, that's widened out. I mean, the what's interesting, I think in the last commitment of traders, it was reported that people were liquidating length in WTI, gasoline, heating oil, and gas oil, but they were buying Brent. So they were. It's kind of like a weird thing, and I think that was more for the hurricane, because the hurricane came in and it was dampening demand more. It was more a demand issue than a supply issue, but also the ongoing issue of takeaway capacity in Permian area. We can produce more than we can take out, and so oil in sort of the mid-continent Cushing becomes a little stranded relative to the rest of the world. So we've seen some little activity on those options in the minus $10 puts for December. I'm not sure. I think they don't trade very actively, so it's probably just one person doing it, not a big, it's just one person's opinion. But yeah, that could stay under pressure for a while. I don't know what Andy said on that, but the increased capacity is not supposed to come until next year, and I think in the second half of next year. So, which would help ease that a little bit.
Yeah, it's been a pretty interesting spread. Like we said, commodities have really been a hot topic for the year. We've had metals really trading heavy, whereas oil, Brent, and WTI are up over 15% each. But more recently, that spread's been has been talked about a lot. With it's almost a $10 spread right now.
Well, you think about back in 2011, where that spread blew out to something like minus $27 WTI under Brent, and you had the Goldman Sachs Commodity Index was mostly weighted to WTI, and then you had I want to a major airline was hedging jet fuel using WTI, so worldwide use of jet fuel using WTI because it's the most liquid market, and the spread from Brent went to minus 27. And then the Goldman Sachs index said, okay, we're going to put more Brent into our weighting. And the airline said, we're going to hedge using Brent and not WTI. And of course, once all those groups moved into Brent and not in less of the WTI, including, and also a lot of takeaway pipeline capacity was built, that spread turned around. So so had they stayed, it would have come back. But it took a long time, and all the mean reversion traders lost their shirts in that market. Can it get down that far again? I don't know. I just it's not something I have a good feel for. But I think where we say it's at -9 right now, something like that.
Yeah, it's pretty close to $10. I don't have. Yes,
I think
I had actually. It might actually be slightly above 10. I don't have the last on Brent. I have a delayed quote, but it's pretty close to 10.
Yeah.
Any other sort of interesting kind of anything interesting you're focusing on at the moment, away from crude?
Well, what we've talked about today, what I'm trying to look at is it a good time to be buying puts? I mean, I would like a little story that I could think about in my head to that could unfold, and I just not. It gives me maybe a corrective kind of a move, but not a really sharp move down below 60, 65. So do I want to buy puts for a move like that? I don't know, but that's what I'd be looking at now. But I think if the last person isn't in on this market, I don't know. Maybe we get. I mean, anything can happen. Listen, we could bust above 70. The funds still have capacity to buy more, so that's still out there. But I think this market has its next move. If you say what's the next $10 move in crude, WTI that is, I'd say it's to the downside. And personally, for my own small specking account, I bought some platinum. So I'm looking at buying metals as well. So
interesting.
That's just from talking to Ed, and it's not no big size. It's just for fun.
So you guys typically, tell me more about Commodity Research Group. You guys work together, you, Ed, Andy, you put together a monthly piece and you consult a number of different clients. What sort of, the typical client, what's the typical client, I guess? Is it, what sort of space are they working in? Are they speculators? Are they hedgers? Things like that?
Yeah, most of them are hedgers. I have one hedge fund that I deal with. This is an old oil client of mine, and he's an options trader, and he's he basically has ideas about where the price is going, and then he'll put option strategies around that. So that's he's trading. He's not a market maker or anything like that. So that's a one of the clients. The rest of them are all oil companies, in different, pipeline companies, you know, um, uh, integrated oil companies. I've done some option presentations. What I find people are interested in is this real option stuff that I talk about. So I have done some work with a pipeline company that we're trying to show them that the pipeline is an option on the spread, right? So you you have a price going into the pipeline and a price going out. So if you're a producer in Marcellus Shale and you're sending gas to New York City during the cold snaps, you wish you had pipeline capacity because you could buy it at a low price and sell it at a high price. And that's an option. So there are all these kinds of assets in the world of energy that have optionality. And then I'd say less so, but part of my career was showing oil companies that they shouldn't be giving away this optionality to the traders who knew what they were getting, and basically they should keep it for themselves. And so that's still stuff that I've been doing, and I've been getting into the power markets a little bit because if you think about a transmission line, that's an option. I mean, I see that as there's much more constraint in it. The when what we call it demand management, when we have Con Edison here, but when they have clients that they can take power away from during peak hours, and they pay money for that. If you come from an option world, you say, well, that's an option. You can price that up, and how much are you paying them, and what is it worth to you? But I find utilities they're not profit maximizers like oil companies are. So it's taking a little more time to get involved in that market. But basically, that's a lot of the stuff I do is educational work.
Yeah, oh, that's great. Well, thanks a lot for the information. A lot of great information. Jim Colburn of Commodity Research Group. We speak with Andy LeBeau, Ed Meir, and Jim Colburn. They got a great team working together there. Thanks a lot for the info, and we'll speak to you soon, Jim.
My pleasure, Michael. Talk to you later.
All right.